So, ladies and gentlemen, esteemed guests and fellow attendees, thank you for joining us today for a keynote address this afternoon. It is with great pleasure that I introduced our distinguished speaker, Professor Pascal Saint-Amans. Many of you may already be familiar with Professor Saint-Amans, a luminary in the world of international taxation and fiscal policy. He wears many hats, including that of a partner at the renowned Brunswick Group and a professor at the University of Lausanne. Professor Saint-Amans' journeys to this prestigious position has been nothing short of remarkable. Prior to joining the Brunswick Group, he held the pivotal role of Director of the Center for Tax Policy and Administration at the Organization for Economic Cooperation and Development. During his tenure, he played a pivotal role in shaping international tax policy reforms, working closely with G20 countries, and his leadership was instrumental in ending bank secrecy and spearheading the base erosion and profit shifting project, updating the rules for taxation of multinational enterprises. With a background that includes the graduating of the National School of Administration and serving as an official for the French Ministry of Finance, Professor Saint-Amans has accumulated a wealth of experience. He's not only held various positions within the Treasury, but also contributed significantly to international cooperation in tax matters as a member of the UN Group of Experts. Furthermore, Professor Saint-Amans served as the financial director of the Energy Regulation Committee and played a pivotal role in introducing new electricity tariffs. Beyond his impressive career, Professor Saint-Amans is a dedicated academic, holding his professorship at the University of Lausanne, and his diverse expertise, ranging from history to politics, enriches his perspective on tax matters. In November of 2022, he did join the Brunswick Group as a partner based in the Paris office, and he continues to serve clients in tax matters. His advisory role enables him to guide some of the world's leading companies through critical issues. And most notably, his work at the OECD led to groundbreaking achievements, including the end of bank secrecy for tax purposes and the global agreement on a 15% minimum tax by more than 130 countries in October of 2021. Ladies and gentlemen, it is an absolute privilege to have Professor Pascal Saint-Amans with us today, a true luminary in the world of international taxation, who continues to shape the future of global fiscal policy. Please join me in extending a warm welcome to Professor Saint-Amans as he shares his invaluable insights with us. The floor is yours.
Thank you. Thank you so much. It was so nice that I thought it was an obituary for a second, but I'm still alive, even though I'm on the screen. Apologies for that. Among the activities May hasn't mentioned, I'm a non-resident fellow at Bruegel. Bruegel being, as you may know, and you were reminded that the UK is still part of Europe in a sense. So Bruegel is the think tank which serves European institutions, and I do tax there, and it's the annual conference which I had to attend, which deprived me of the pleasure to meet you personally. I can see some shadows at the back of the room because I can see the room. So please don't all watch your phones while I'm speaking because I will see it. But unfortunately I'm not with you, and I have never been to Cambridge, so it would have been a pleasure. Thanks very much for the invitation. Extremely honored and privileged to address you today. And I try to make it lively because seeing, a French guy on the screen with a French strong accent may not be the most amusing thing you will be confronted with today. But I try to do my best to share with you an overview of where the international tax framework stands today. And today is a world of fragmentation. So I try to give you a sense of where we come from, where we are, where we're heading with the international tax framework. To start with, I think we need, as always, go back to basics. And the basic thing in the international tax world is that tax is core to sovereignty. And we could go back to the good old times of the war between England and France in the 13th and 14th century, because that's where, and it's evidenced by some historians, that's where the concept of sovereignty emerges, and it will translate later in the 17th century with the Westphalia Treaty as the international community being made of sovereign states. But the concept of sovereignty and the concept of modern states were born at the time of that war, which needed funding. And to fund a war, what do? You raise taxes. But at some point, you raise taxes so much that you need to seek the approval of the people who are going to pay the taxes. And that's where you have in France, for instance, the first parliament, and that's where you strengthen the House of Lords in the UK. So sovereignty is very much linked, the principle, the concept of sovereignty, with the concept of tax. So why am I going back to medieval times to start an address on contemporary tax? Because actually this role of tax in sovereignty is still defining international tax matters. The world is made of sovereign states, and tax is at the core of sovereignty, which means that there is little room for tax cooperation. Or in other words, there is no such thing as international tax. And that's a joke you can tell to your students when they start a course on international tax. It actually doesn't exist, because tax is primarily a domestic matter. The people of a country, through their representatives, will consent to tax, will define their own tax policies. And tax policies are very much inward-looking. They're not outward-looking. The only link with what's happening across the borders is that countries tax their residents. It's a concept of residency, except for the US, which is an exception, as is the case in so many other areas. But domestic tax will primarily focus on residents, and you tax your residents on a worldwide basis. Okay, and you will tax the non-resident on the business they do within your country. So that's where you have an international dimension appearing, because your residents may earn income from outside your country, and you want to take this income into account, at least when they are individuals. For companies, slightly more complex. And the non-resident may earn income from your country, and you want to tax it. And that's where you have the first elements of international tax appearing, where the governments the countries move to direct taxation. The whole 19th century is about indirect taxation. It's about stamp duties. But and we're back to war. With the First World War, you have massive needs for revenue. And that's where the countries in the West, the US, the UK, France, and then Germany, have introduced income taxes. I pause because in income tax, you have both personal income tax and corporate income tax. And both were born at the time of the First World War in the 1917-18. And that's where countries introducing direct taxes and having this question of, well, I want to tax income generated outside of my boundaries, outside of my borders, by residents, and the income derived by non-resident from my country. They had to face the issue of double taxation. The same income may be taxed twice in the country of residence, but also in the country of source. And that's where the League of Nations decided to launch some work. We're in the mid-20s, 1920s, a century ago, and this work culminated with a report by economists, which was endorsed by the League of Nations, to put in place a model for a tax treaty. So a model tax treaty emerged with some basics of international tax that we could summarize to tax treaties. So the international tax matters will be dealt with by countries through international agreements, which are tax treaties. The tax treaties are, that's the second lesson, extremely limited. They are limited to eliminating double taxation. So the purpose of the tax treaties is extremely small. And tax treaties are prevailing over domestic legislation as per the rule of law and the hierarchy of norms. But what is extremely interesting and quite exceptional in international tax treaties is you may have a taxing right from a tax treaty, but if you do not have domestic legislation, you cannot exercise this right. In other words, tax treaties are above domestic legislation, but they are second to domestic legislation because you need to have taxing rights from domestic legislation. Finally, in tax treaties, you will find in the model of the League of Nations, you will have rules where multinational companies, meaning companies operating in more than one country, they are one economically, but they have different legal entities. And back in 1928, the League of Nations decided to ask companies to play as if they were all separate from an economic perspective, meaning that the legal entities have to price internal prices within the company as if they were third-party prices, market prices. So that's the context. And this context has been very stable for almost a century. I would say 80, 90 years. Governments negotiated tax treaties. Today, you have around 3,500 tax treaties. They more or less all follow the same model. Following the League of Nations, you had an OECD Model Tax Convention, which was published in 1955, and the OECD has updated the Model Tax Convention, but fundamentally, it has remained quite the same. The UN came later in the game without an intergovernmental body, but the UN Secretary General issued his own model tax convention based on the advice of experts. They are globally similar, even though the OECD one gives more taxing rights to developed countries, while the UN model will give more taxing rights to developing countries. But fundamentally, you have tax treaties, they're very limited, and they don't provide, or they didn't provide much for tax cooperation, just the elimination of double taxation. And it's extremely hard to change tax treaties. You know, in the previous life, I was in the French government negotiating tax treaties for the Ministry of Finance. And very often when the minister wants to do reform, and very often in a reform, you would like to tax non-resident more, or you would like to tax your residents more than they are. And you're limited. You're limited because you have tax treaties. So most of the reforms, when they have an international dimension, are extremely constrained. And that's another reason why this international tax system has been very stable. And it remained the same while the economy was fundamentally changing. I mean, you could say that the increase of trade following the Second World War was a significant change. But I would date the fundamental change to the 80s and the 90s, where actually countries decided to go for not only the open trade, but the financiarization of the economy and deleting as many borders as possible, which would prevent from freedom of investment, freedom of trade, freedom of circulation of capital. And during the 80s and the 90s, you have a profound transformation of the economy that we can see today. And when you add to that the digitalization of the economy in the late 90s and in the 2000s, you have moved from a brick and mortar economy 1 century ago to a completely different economy where one, multinational companies play a much bigger role. Second, they are extremely integrated economically, and the value chain has changed in such a manner as the value is now on intangible property and no longer on the tangible stuff. It's not the fact that you own a factory somewhere. And by the way, as a large multinational company, you no longer own factories. You outsource to toll manufacturers where there will be little value so that you can concentrate the value on financial stuff and on branding, on intangible stuff. So the economy has changed profoundly from brick and mortar to an intangible type of economy where, by the way, given the globalization, which is this phenomenon in the 80s and the 90s, globalization has resulted in a few winners. and the winners take it all. When you look at multinational companies today, you can see that just a few will earn more than half of the profits totally gained by multinational companies throughout the world. So you have a high concentration of profits in a few hands. And these few hands are the hands of large multinational companies or high net worth individuals. If you want to talk about the rich, in English, you say high net worth individuals. In French, you're much more brutal. You say les riches, the rich, right? So these people, large multinational companies as well as the rich, I would call them. I'm a French socialist, so I have to assume what I am. They can play globally. They are not stuck in a country. And they have been able, because all these frontiers have disappeared or have been attenuated, they have been able to play on tax sovereignty, to play one sovereignty against another. In other words, the so-called tax sovereignty, which was a way to say, I live in my bubble, I have my tax borders, and I don't care what happens across the border, has turned against the countries which have lost the sovereignty, because it's been extremely easy to shift capital for individuals, but to shift profits as well to the countries or the jurisdictions which were taxing these profits at a better price. And what we've seen in the 80s and in the 90s is this old system to eliminate double taxation has facilitated tax competition and has facilitated what we have called double non-taxation. You didn't want profit to be taxed twice, so that you wouldn't hamper investments. But we have resulted in a system where the existing rules have enabled players to locate their profits in no tax jurisdiction, or nowhere, as was the case with Apple, with an extremely aggressive scheme which located the profit of Apple in the middle of the Atlantic, in a nowhere company. And from double taxation risk, we've moved to the risk of double non-taxation. But nothing changed. There was an attempt in the 90s by Bill Clinton, who wanted at that time to do the healthcare reform that Obama did later, to collect more tax, more revenue. And he was concerned with the revenue from corporate income tax, which was shrinking in the US. But the efforts to tackle what one would call the tax haven issue, they did not work that well, because Bush was elected in 2000, and Bush was surrounded by people thinking that there were no tax havens, there were tax hells. Tax is bad. Tax funds large, big government. Big government is not really good in the US in general, but in particular with the Republicans. So the Center for Freedom and Prosperity, which is an American think tank which doesn't like tax at all, and which didn't like the OECD efforts to fight tax havens, say, no, tax havens are good because they put pressure on tax hells to reduce the tax burden. So this work didn't didn't deliver much because of the election of Bush, who stopped that on the one hand, and because on the other hand, the OECD, which at that time probably had 26, 28 countries, started tackling non-OECD tax havens. Because as an international organization, you cannot blacklist your own members. So what you do is that you look outside of the organization. You look at the small Caribbean island. You look at the small Pacific island. You look at Singapore and Hong Kong. They're slightly bigger, more influential, but you can afford tackling them. But you cannot tackle Switzerland, or you cannot tackle Luxembourg, which are two countries known at that time, at least, to be tax havens. So what happened when the OECD started blacklisting countries for not complying with its own standards? These countries said, well, sorry, but fix your own problem first before coming after me. And when I started at the OECD in 2007, we were in this environment where nothing was really happening. And I joined the OECD mainly to improve my English, with the hope that one day there would be a democratic president who may just reboot this conversation. In 2007, I started the OECD, and I do my courtesy visits to the Bahamas, to Cayman, to Jersey, and all these people said, well, you may be a nice person, maybe, but for sure you will come back here when you blacklist Switzerland, because you're not entitled to tell us to change when the OECD is not changing. Lesson learned. And I'm coming to the big shift which occurred in 2008. Actually, it starts in August 2007, but the big shift is the global financial crisis. And the global financial crisis is a fundamental change for our lives in the world from an economic perspective, but in particular in the tax world. Why so? Well, the tax havens had nothing to do with the global financial crisis. But leaders of the G20 decided that somebody had to pay a price. And the price had to be paid by tax havens because the people would understand that. But there is more to that than just a scapegoat exercise. So the global financial crisis, as you know, started in August 2007 with the subprime crisis, and it really blows out in September 2008 with the collapse of Lehman Brothers. And during that time, what happens is that you have a leak. You have papers. You may have heard about the Panama Papers, the Paradise Papers, the Swiss leaks, the Lux leaks. But the first of them that people have forgotten about is the Liechtenstein scandal. On Valentine's Day, the president of Deutsche Post is woken up by the press, by the TV crews at 6 o'clock in the morning, and the police, because he did hide 1 million euros in a trust in the bank of the Prince of Liechtenstein. Tax fraud, tax evasion, as we say in English. And this triggered a global scandal throughout the world. It was on the front page of all the papers from China to the US. Why so? Because we are in February 2008. It's after the first doubts on the stability of the financial system have started. Governments for decades have agreed to lower wealth taxes or to suppress wealth taxes, to reduce the taxation on capital under the pressure of the financial world, the financial system. And what they realize with the Liechtenstein scandal is that beyond this individual, there are thousands of people from tens of countries who have massively hidden their money in the tax haven. While the taxation of capital has diminished, the level of tax evasion has not diminished. And as the global financial crisis is coming, and as the bailing out of banks is in front of governments, if you're a finance minister, whether you're left-wing or right-wing, there is a very simple equation. You need to put hundreds of billions, trillions of euros or US dollars to save the banks, which are helping taxpayers not to pay the taxes that you need to bail out the banks through bank secrecy. What you say when the global financial crisis hits is we need to put an end to bank secrecy. We need to address the tax haven issue from this transparency perspective. Tax havens were defined as having no tax and no information exchange. As I told you, the initial tax treaties didn't provide for tax cooperation. You didn't have to assist the other countries to collect the tax, which was not yours, which was theirs. And Switzerland, Luxembourg, and other 50 countries in the world had extremely strict bank secrecy. The global financial crisis unlocked this for a couple of reasons. One, because you had to bail out the banks, and two, because you had the top-down approach. The world is collapsing. If you're a leader of a country, you think of fixing this. And you think of sending messages to the people who are suffering, to the people who will have to pay for the financial crisis, which are the people, the women and the men in the street, who will face quickly after 2008 an increase of VAT, an increase of personal income tax, while the fat cats didn't pay anything, while the high net worth individuals could hide in tax haven countries. So The G20, which emerges, which brings a global governance at the leaders level, says we need to crack down on that. And the last reason why it worked is you had an agile international organization, the OECD, which was able to say, listen, we have standards. We can move the needle. We can fix the thing. Trust us, and we'll move ahead. The way to do it is to start blacklisting not only the small Caribbean island, but Switzerland, but Luxembourg, but Singapore, but Hong Kong. And this is what happened. And that started a mechanism of tax cooperation and of progress. And that's what I would call the tax paradox. The tax paradox is in international matters in general. If you conclude a treaty, let's take trade or investments, you limit your sovereignty. In tax, it's rather the opposite. If you don't have agreements which go beyond tax treaties, you lose your sovereignty, as had been the case with tax competition. If you want to recover your sovereignty, you need to know what happens across the border, and you need tax cooperation. So the tax paradox is, if you want to have progress for your own assertion of your own sovereignty, you need actually to do international tax. And this is clearly what happened as of 2008. So let's describe relatively quickly the three main steps which have transformed the international framework, and then I will conclude on where we are today, what the challenges are, which will be after back to the basics, back to the future. So the three phases of the international tax reform. Such reforms occur once in a century. Previous time was League of Nations in the 20s, and the most recent one started in 2008. And I think we could say it probably culminated in 2021. And during that period, we had three main achievements. The first one is the end of bank secrecy. I mentioned to you that was the way the G20 started dealing with tax haven. And in a few words, what was achieved? Well, one, a standard to provide for exchange of information requests. What does that mean? It means that if a country wants to know something about its taxpayers in another country, because the taxpayers may have a bank account, it is now entitled to ask for the information and to get the information. Until 2009, this was impossible. If you wanted to have information from Switzerland, there was the need for a tax crime to be committed in Switzerland. And the tax crime, as defined by the Swiss law, was that you had to kill, boil, and slice the tax auditor in Switzerland. Not that extreme, but not far. I mean, you had to forge documents and to act extremely badly, which means that there was never tax fraud in Switzerland. You would never get anything from Switzerland. With the standards agreed in 2009 and endorsed by more than 160 countries today, you have the obligation for all countries to exchange bank information and all type of information. But there was a second step starting in 2012, 2013, following a US push. The US said it's not good enough. The Swiss bankers played games on us. So we want to really crack down on them. And we don't feel like just asking for one piece of information. And by the way, we need to give the name and the address of the person we are investigating. We want this information to be reported to us automatically. And the US enacted unilateral extraterritorial legislation. It's extremely unpleasant when you are a non-US country, right? But it's extremely efficient when you have the power, the firepower of the US in terms of economic weight. So the US adopted what they call Foreign Account Tax Compliance Act, known as FATCA. And FATCA provides that all foreign banks have to report all the information on US taxpayers to the US. The bank account number, the balance on the bank account, and all the transactions on the account for the past year. All that has to be reported automatically to the US. And the US enacted FATCA in 2011. I can tell you that the other G20 countries, in particular France, Germany, but also China and others, said, wow, we want the same. We want exactly the same from Panama, from Switzerland, and from the others. So they turned to the OECD to say, you know what? I mean, that's the new game in town. Can you make it multilateral? And we use the G20 to make that standard multilateral. And we had to engineer the mechanism to oblige the countries to move to that standard. If you're Switzerland, you don't like it, you don't want to do it. And that's where we use the stick of the threat of a blacklisting. So my role was a nasty role of establishing blacklists or threatening countries of doing blacklisting. And that worked. And this common reporting standard, which is a multilateralization of FATCA, was adopted by the G20 in 2014 and 15. And today, to jump to the conclusion on exchange of information, you had more than 100 countries which do exchange information, financial information, automatically with each other. You had last year more than 150 million bank accounts reported across the border, automatically. Countries have collected more than 150 billion euros of revenue from offshore bank accounts, from more than 700,000 people who reported these bank accounts and who are now automatically reported. So this was a massive change, and this change came together with, and I refer to the Bahamas and Cayman telling me, well, you need to include everybody. We did list Switzerland and the others, but we did bring the Bahamas and the others on an equal footing to the OECD, as well as developing countries. And today, the Global Forum on Transparency, which deals with these matters, has more than 165 countries. And what they do is peer reviewing, because you can commit to a standard. It's better to implement it. But who's going to assess the implementation of the standard? The peers, because tax is a matter of sovereignty. It cannot be a group of technocrats doing it. So the peers are doing it. But when you have the G20 dynamic of 80% of the world economy saying, if you don't comply with the standard and if your peers are not happy, we're going to blacklist you, you have progress. And you can make the difference, which is literally what happened. So I think this is done. The second phase started in 2012, because at that time, the French President Sarkozy, you may have heard of him, extremely agitated president, said, well, in 2009, he wanted to claim victory because Switzerland had committed to exchange of information. He said, les paradis fiscaux, c'est fini. Tax havens, that's over. It was not over, obviously not. It was just the beginning of the end. And the beginning of the end on transparency. But you had something else than transparency, which was no tax. And the OECD here again tried in the mid-90s to address the no tax jurisdictions, but the election of Bush said, no, we don't want to tackle that. And that's where in 2012, I took the initiative to tell the G20 spontaneously, you know what, guys, I mean, now that we've addressed transparency issue, let's move to the second one, which is no tax. And we cannot really tell countries that they have to put in place a tax. It's much too early. But what we can do is fix the international tax rules which are broken. Tax treaties, as I said, were good at eliminating double taxation. Too good at that. They resulted in eliminating taxation at all. So we told the G20, why don't we fight base erosion and profit shifting? And we'll take your political weight to put pressure on all the countries to change the rules and on the companies to comply with the new rules. The existing rules facilitate base erosion and profit shifting. It's not the fault of the companies, it's the fault of the government which let it go. So let's ask the government to change it altogether. And the G20 at that time, 2012 to 2016, was still in a positive dynamic. I would say the culmination of multilateralism through the G20 was probably the Chinese presidency in 2016. So during that time, 2012, 2016, we did change international tax rules. Some would say we patched the system through the BEPS project, which had three main pillars, let's say. The first pillar was bridging the gaps between tax sovereignty. You had tax treaties, but tax treaties were just about the frictions where an income was cross-border. But there was no such thing as articulating sovereignties with each other. In other words, it was very easy in a world where you had no more borders than the tax borders to shift profit from one country to another, or to take advantage of discrepancies between the qualification of income between countries. That's where you have hybrid mismatches of entities or of products. You have a payment between France and Italy, which are not tax haven. This payment is an interest payment from a subsidiary to its parent company. It's an interest payment in Italy, which means that the interest is tax deductible. But guess what? Because it's a hybrid instrument, a bond convertible into a share. It's a bond in Italy, it's a share in France, because it's hybrid. A share, what you get out of a share is a dividend. A dividend is tax exempt. So for the same group, subsidiary parent company, you have a tax deductibility here and no taxation there. You just create tax credit. You create a double dip. Nobody's losing, they think, Italy or France, because it's compliant with their legislation, but overall they are losing. So the first part, the first branch of BEPS was to address these discrepancies and tell countries you cannot define your own domestic legislation without taking into account what happens across the border. If it was an interest in the other country, don't deal with it as a dividend. And that's action 2 of the BEPS action plan on hybrid mismatches. I could describe some more, like interest deductibility, or obliging countries to exchange information on generous tax rulings they were giving, like Luxembourg, which was the country of extremely generous tax rulings, which worked because they were secret. So Luxembourg was sucking the tax base of other countries through rulings, but it was not informing the other countries. If it had informed the other countries, the rulings wouldn't have taken place. And that's where we fixed a number of issues with this first leg of the BEPS action plan. The second one was to say existing rules, tax treaties, they don't work. Transfer pricing rules, how you price transactions, the market price within a group, it worked when you had a brick and mortar economy. In a fully integrated economy or fully integrated business models, it doesn't work. What's the price of an intangible, the market price of an intangible? You don't have a market price. So companies do it the way they want. And by the way, they can put the ownership of the intangible in Bermuda. And the ownership, so you fund an entity in Bermuda, your subsidiary, and it's financing the development of the IP, of the intellectual property in the US, but it's the legal owner and it's the financial owner. So all the profits goes to Bermuda. Doesn't make any economic sense. But from a transfer pricing perspective, that was the rule. It had to be fixed. And transfer pricing and tax treaties had to be fixed, especially as tax treaties could easily be abused with beneficial owners shifted from one country to another. Just an example, you had some countries who specialized in being treaty shopping hubs. So to invest from France or from the UK to India, you would not do it under the bilateral tax treaty between the UK and India. You would go via Mauritius, because Mauritius had the exclusive taxing right on profits in India, and they would not exercise them. So Mauritius represented at some point 27% of direct investment in India. This had to be fixed. The treaty abuse had to be fixed. Finally, the countries agreed that we would need to improve transparency. The taxman or woman in a country from a tax administration would just see the transaction between the local subsidiary and other countries, but not. So let's take the UK. You would see what happens in the UK and the transaction between the UK and Ireland, but you wouldn't see that it would shift from Ireland to Bermuda, where the profit would not be taxed, while the global tax director of the company would see it. So you had to level the playing field between tax administrations and taxpayers. And that was about transparency, which turned into what we call country by country reporting, which will become public in Europe very soon. So you had these three aspects: bridging the gaps between the sovereignties, fixing the existing instruments, and increasing the transparency. Now, BEPS was delivered in 2016. There was a need to bring all the countries. So like the Global Forum on Transparency, we did establish an inclusive framework for BEPS with today more than 140 countries to make sure that the minimum standards emerging from the project would properly be implemented. So there were some success. There is no longer treaty shopping. I mentioned treaty shopping with the example of Mauritius, but I could have named the Netherlands or Singapore and many others. This is gone. Hybrid mismatches was largely implemented. I mean, the rules neutralizing them, it's gone. It's a business model which has disappeared. Transfer pricing, what was done was to say, well, you need some substance if you want to put profit, but this resulted in bringing more substance to tax havens. You bring a full R&D team in Bermuda, or you shift thousands of employees in Ireland. So when the goal was to realign the profit with the substance, what happened was that substance was realigned with the profit to keep the tax competition. So it was an improvement. I mean, moving from zero taxation in Bermuda to 12.5% in Ireland. Actually, the effective tax rate was probably closer to 6%, but that was not really the goal that countries had pursued. And in some actions, I mean, fixing tax treaties, yes, treaty abuse was fixed, but the idea that a company could be taxed in a country without necessarily being physically present in the country, that failed. And as part of the BEPS action plan, there was a work on how to address the tax challenges of the digitalization of the economy. And that failed because good Obama said, sorry, guys, I don't want to hear about that. We want to tax our companies, or we want to leave the profits to Bermuda, but you shouldn't tax them because it belongs to us. You want to tax Google, you the French or you the Brits, but Google's value is with us because we are the brains engineering the research engine. You just have fingers. We have brains, you have fingers to click. You generate income by clicking and you generate advertising income for the company, but you don't create value. So the value is with us. So you had this debate, or where is the value created? And BEPS didn't address that. And on digital, there was a big frustration that this had not been addressed. And as regards transfer pricing, as I told you, countries left the game not that happy. So I'm moving to the third part and the conclusion, which is that in 2016, you have the BEPS action plan endorsed, implemented, the inclusive framework built, endorsed by China. Everybody kisses each other. It's full love, but you have big frustration. In Europe, European countries think, well, we are not able to tax the digital companies. These companies do not have a physical presence in our countries, and therefore our tax treaties prevent us from taxing them. And even if they were physically present, the amount of profit they leave to us is very small. All the profits are booked in Ireland or in Singapore if you're in Asia. They are not booked in France or in the UK or in Germany or in the large markets. We're extremely frustrated, or in Italy or in Spain, to name the countries which were extremely angry with this outcome. And these countries said, well, the OECD was not able to deliver. We're going to act on our own. And the French, who are the world tax champion, as you know, took the lead. The French finance minister said, I want to tax the GAFA, the Google, Apple, Facebook, and Amazon, and the like. So we're going to put unilateral taxes to tax these companies. So that was, I mean, clearly moving away from the consensus from what had emerged from the OECD, which was we don't touch this topic until 2020 as per the request of the US. The other big thing which happened at that time, we're in 2017, is the election of Trump in the US. And Trump does a reform, a tax reform, the Tax Cuts and Job Reform, which is a massive reform, the first one since Ronald Reagan in the 80s. And the goal as was the case with Reagan in the 80s, is to slash the rate from 35%, which was the highest rate in the OECD, to 21%. But doing so, the US needs to broaden its tax base. And to broaden its tax base, it has to tax international income, which was gone because of base erosion and profit shifting. And they hesitated in 2017. The House voted a fundamental reform, which was not endorsed by the Senate, which was a move to destination. Destination meaning you will tax the profit of companies where the clients are, where the customers are. Not where you locate the intangible property or the ownership, but where the clients, where the customers are. Why so? Because the only thing that a multinational company cannot play with is where the customers are. You can shift your factories. You can shift your intangible. You can shift your profits. You cannot shift your clients. You cannot shift your customers. And the destination-based principle was a recognition that actually the bulk of the profit should belong to the country where the customers are. This was invented, I'm not sure I'm allowed to say that in Cambridge, so I'm hesitant, but this was invented by a professor in another much less prestigious university, which is called Oxford. I don't know if you've heard about this city in the UK, but Michael Dover in Oxford with a couple of people in the US engineered this destination-based cash flow tax that the House endorsed. But this would have blown out the whole international trade system, because it means that on a Louis Vuitton bag, to take an example, the US would tax the totality of the profit. You take the cash made in the US, $5,000, and you deduct the expenses in the US. And that's the profit you tax under the destination-based principle. If France doesn't do that accordingly, you have massive double taxation. And as you tax where the customers are, if you are Boeing, you're manufacturing planes, you're selling them abroad, you deduct the expenses in the US, but you're not taxed on the income because the customer is Chinese Airlines or Air France. And as a result, you have massive export subsidies, and you can see the impact on the trade system. And the Senate said, that's much too much. We cannot go that far, especially with Trump in the White House. So the Senate was more reasonable, let's say, and said, let's implement BEPS in the US. We want to broaden the base. The OECD did it, we do it. But the OECD didn't go far enough because of us. So what we're going to do is we're going to put a limit on the profit you can shift through transfer pricing. And they called it, ironically, the beat. I mean, they beat companies so that they cannot shift profit above 100 million dollars of intragroup services. And on the other hand, they did put in place a global minimum tax, which they ironically called GILTI, G-I-L-T-I, for global intangible low tax income. It's a global minimum tax of 10.5%. And this was the case with FATCA, where other countries looked at this with envy. The Europeans said, wow, we actually can do a global minimum tax, as the US has done that. We want the same. And that's where in 2017 started a conversation on a two-pillar solution. Pillar one was, we don't want DSTs, or some countries want digital service taxes, but this is unilateral. And the US doesn't like its companies to be taxed through unilateral measures, which is taxation on gross income, transaction taxation, which is not smart, which is not good, but which is politically easy rhetoric for European countries. So the US said, if you do DSTs, we're going to hit you with trade sanctions. And they all said, okay, let's find a global solution at the OECD, which will revise these nexus points. A company can be taxed even if it's not physically present. And it has to get more profit, the country where the customers are, than in today's system, which is a move towards destination. So it's not the US tax reform, but it's moved there. Finding a multilateral solution will give more taxing rights to the French, the Brits, the Spaniards, the Italians who did introduce digital service taxes on American companies. And the Americans said, we can do it, but we want to tax Louis Vuitton more. So it's not only about digital, it's about where you have high profitability. Above 10% profit, there is a rent. We want to allocate part of the rent to the market. And that's the conversation on Pillar 1, which started in 2017-18. Meanwhile, on a parallel track, the Europeans said, well, this global minimum tax is a fantastic idea. We want to do it. And Trump said, yes, do it. You're free. As long as you don't tax American companies, we have it. So it's fine. Increase the taxation of your own companies. Do a minimum tax. And we've worked on establishing a minimum tax from 2018 to 2021. Of course, I mean, good Obama said, I don't want to do anything. Bad Trump said, let's do something multilateral, which was a paradox. I thought he would fire me as a French socialist at the OECD dealing with tax. And actually, they called me and said, can you support the US in the tax reform? So we worked with the US and with bad Trump, except that, of course, there were, I mean, it was the roller coaster. One day, yes, we'll move to an agreement. The day after, no, we won't move to an agreement. So it was a bit rocky. And at the end of 2020, when COVID hit us all, we just kept this project surviving, waiting for the new election. And the new election brought Biden, who said, you know what, this is my top priority. Putting in place a real minimum tax as defined by the OECD, not guilty, but a minimum tax where we tax the difference of the profit made by our companies abroad when they are below 15%, while guilty was looking at the global average. I have half of my profit in France at 30%, half of my profit in Cayman at 15%, at 0%. The average is 15% above the 10.5 of guilty. Biden said, no, we have to look at it country by country. If there is profit, a pocket of profit in Cayman, I want to take the difference, the 15%, and it's 15%. So we had to negotiate that. It was a blitzkrieg because Ireland didn't want to move above 12.5%. Ireland is the only country in the world where taxi drivers knew about the corporate income tax rate, and they knew about the job I was doing when I was in Ireland. I was not very popular there. So the US managed to impose 15% as the minimum tax on a country-by-country basis. And they agreed on the deal on Pillar 1 to say, for the largest companies, the winners take it all. The companies above 20 billion euros of revenue, 10% profitability, if they have more than 1 million of income derived from a country, this country is entitled to tax its part of 25% of the rent, in addition to the existing profit. So it's a shift towards destination, and they agreed this on the 8th of October 2021, together with the minimum tax. Conclusion, where we are today and what's going to happen. Interestingly, Pillar 2 has happened, is going to hit countries on the 1st of January 24. Some of you may say this guy is delusional because the US and China are not implementing Pillar 2. They are not implementing the global minimum tax. So it's not happening. And you're wrong. Because Pillar 2 was designed in such a manner as it's enough of a critical mass of countries for this minimum tax to have an impact without the US and China implementing. US was a surprise. I mean, Biden failed. Senator Manchin objected to it. China was not a surprise. They said they would not implement. So the Europeans adopted it. Japan adopted it. The UK adopted it. So did Korea, Canada, and many other countries. And with that, you have a critical mass of countries where multinationals are incorporated. So these multinationals will be subject to the minimum tax. But the mechanism is such as for the countries which are not implementing the minimum tax, the US, American companies operating in Europe will be taxed in Europe in the profit they shift to low tax jurisdictions. So that's a two-layer mechanism, a two-pronged approach, if you want, where you have an income inclusion rule for the countries of residence of the multinational companies, but you have another tax payment rule, which is you tax the profit made abroad if they are not taxed by the income inclusion rule of the country of residence. So American companies will be taxed in Europe, in Japan, and elsewhere. And you have enough of a market here for all the profits sheltered in tax haven to be taxed. And that infuriates the US Republicans and US Congress in particular. And they were at the OECD 2 days ago to complain, or last Friday, to complain about that, but nothing they can do except maybe trade sanctions. But the US will do a tax reform in 2025, and I guess they will implement Pillar 2 because the dynamic has been very devilish, or the engineering has been devilish and is working. There is now a global minimum tax of 15%. You can play slightly with it. I don't get into the details, but very little. And that will wipe out all the cash boxes in the world. All these entities where you had no substance, massive profit, and it will have an impact on transfer pricing rules. Pillar 1 has made some progress since 2001, but is a hard proposition. Why is it a hard proposition? Pillar 1 is about this reallocation of taxing right and new nexus. But to do that, you need to change tax treaties. And therefore, you need a multilateral convention to change the tax treaties. And there is an agreement that there is a need for a multilateral convention. There is even an agreement on the text of the MLC, subject to a couple of things. You will see the G20 leaders who are meeting over the weekend. On Monday, they will issue a a communique saying, well, we're almost there on the multilateral convention. They still pay attention to that. And I think it will be solved. And there will be a signing of a multilateral convention by year-end. But the problem is that beyond the signing, you need a ratification. And the US is not going to ratify because Congress would, it's not Congress, it's the Senate, which would need a 2/3 majority to sign this treaty. And bipartisanship is broken in the US. And Congress hates it when the executive takes commitments on their field, the Congress field. So it's unlikely the US will implement. Now, if the US doesn't implement, what can you do? And you're back to square one, which is digital service taxes, which are stupid unilateral taxes, but which are necessary politically for a number of countries. But if they are DSTs, then the US, and it's bipartisan in the US, Democrats as well as Republicans hate domestic digital service taxes. They may take some retaliation measures. So we're back to square one with some tensions which may happen unless the US in 2025 in their domestic reform enacts something which would be this move to destination that you find in Pillar 1. So things are not fully decided, but you will see in the coming months and probably a couple of years, some tensions and some instability to the system. My conclusion, the international tax system has changed profoundly. And I think you're kind of lucky for those of you who will be involved in tax matters to come at a time where you have renovated rules. It's much more fun. Maybe making a bit less money because the good old times where you could do extremely aggressive schemes with a percentage on the tax saved is gone. Tax is now a social matter. It's a matter for the civil society. You have tax justice campaigners. It's part of the ESG. I would say it's the silent T in ESG, and companies and advisors cannot do what they used to do. But the situation is much more interesting from a policy perspective. So it has happened, but it's not yet completely stabilized. It's not stabilized because changing all the treaties takes a lot of time, a lot of efforts. We're not yet there. And there is this need, I would say, towards stabilizing with probably more destination taxation. And that's where we're going to move. I don't know how. I don't know whether the US will take precedence, whether at some point will be partisan in the US, whether we'll get there after chaos, after a trade war because of digital service taxes, but we will get there. So there are a few more years to come. The system is much more complex, and that's where tax advisors will still make a big amount of money because the system is complex. Tax is complex, but when you try to interconnect 200 tax sovereignties with some common rules, which have to be agreed by consensus at the OECD, it's extremely difficult, extremely complex. And the cost of compliance is high, and that clearly is an issue. Finally, And that's something you will have to monitor in the coming weeks. There is a turf issue. Developing countries have said this agenda is a big country agenda, and they're not wrong. It's an agenda fighting tax haven, which was beneficiary to developing countries, but they may have other priorities, VAT, or withholding taxes, or simple ways of collecting taxes, or fighting the gray economy, the informal economy. So developing countries have been frustrated also by the balance between source and residence, and they have pushed their agenda at the OECD in this inclusive framework, which I mentioned, but unsatisfied, they have dissatisfied, they have also pushed it at the UN. And the UN Secretary General has just issued a report, which was mandated by African countries, followed by the UN General Assembly in November last year. A report has just been issued saying, you know what, this tax debate should take place at the UN. And you will see probably a tension between the UN and the OECD. The OECD, that's my former house, proved, I think, its agility and its ability to deliver and to propose. The UN is more legitimate because all the countries are members of the UN, but the UN doesn't have the agility of the US. And you will probably see a debate in a world which is fragmenting, and we're back to the fact that the G20 no longer has the teeth it had back in 2016. Since the election of Trump and the tension between the US and China, the G20 has lost its teeth. You will see some tensions in the governance of the international tax framework, which makes the topic extremely interesting for the months and the years to come. And on that, I will close, and I would be happy to take some questions if you wish. Thank you very much for your attention.